I just wanted to welcome everyone to today's BEI webinar. We have a very fantastic guest joining us today who will be presenting on advanced trusts and how to use advanced trust planning to grow your planning practice. Our esteemed guest, Stewart Sorkin, is the founder of Business and Legal Advisors, which is one of BEI's latest strategic alliances. And he has a vast wealth of knowledge that we're very excited for him to share today. And he has been doing this work in this industry for over 40 years. So for those of you who have attended any of our conferences, Stewart spoke at last year's conference and will also be attending and speaking again this year at the 2023 BEI National Conference in August. So for all of you who are joining us, hopefully you will stay on until the end of this presentation, as Stewart has some offerings exclusive to this webinar and a very, very informative white paper that he has put together for all of you so that you can focus on kind of taking notes and paying attention to the presentation and listening to him speak. So you won't want to miss that. And then I will be here on the presentation to monitor the chat and the Q&A. So if you have any questions as we are going through, just please drop those in the chat and I will be sure to ask Stewart those questions at the end of the presentation. And lastly, BEI will be sending out the recording of this webinar and Stewart's contact information later this afternoon or later this evening, whatever time zone you're in, so that we will be able to contact him and rewatch the presentation again if you would like. So if you have any questions, be sure to drop those in. And with that, I will hand the presentation over to Stewart.
Good morning or good afternoon to all. Thank you for attending this session today. We're going to deal with the complex areas of trust and how they can be used for creditor protection, estate planning, income tax planning, and other ways to assist your clients. But to start off, to keep it simple, there are really only two basic types of trusts. There are those that are revocable, which will help for probate, will be used in certain business transactions, which I will highlight in some war stories later on, and irrevocable trusts. But irrevocable trusts can be divided into two main categories. Grantor irrevocable trusts can be used for tax planning and creditor protection, but they are not income tax. I'm sorry, they are good income tax planning and creditor protection vehicles. They do not deal with estate taxes because as a grantor trust, the grantor is still viewed as the owner and therefore the assets are still within their estate. The third type of trust is an irrevocable trust that the grantor has given up complete ownership. On basic terms, revocable trusts are generally used for estate planning purposes in order to avoid probate, in order to be able to put in a easy way for assets to be handled if the grantor becomes disabled. Because the issue, we used to use powers of attorney a lot for this, but those of you in the financial industry have maybe run into cases where you've tried to take a power of attorney that some attorney applies to a financial institution. They said it doesn't have our language, we're not going to respect it. One of the major advantages of a revocable trust is that once a financial institution takes the assets under the trust name, then they are required to respect the change of trustees, the rules for changes of trustees, and all of the signatories will take place. It is a disregarded entity. There is no tax filings for a revocable trust as long as it is revocable. One area where we have been using revocable trusts recently is in the area that's outside of pure estate planning, is the area of co-ownership of real estate. that if you have non-husband and wife buying real estate together, the idea of setting up a revocable trust where you can specify if one party put in more money than the other and they get that back at closing. What happens if they decide to sell? One wants to sell, what doesn't? What happens if, God forbid, one of them dies while they still own the property? And you actually have put the revocable trust in title. And the advantage of also doing that is a revocable trust will not generate a separate recordation fee as would be required if you put a jointly held real estate in an LLC. Additionally, this type of trust is probably going to still qualify for non-investor interest rates versus an LLC. It does not give it, and if the trust solely owns the real estate, it gives you the same effective creditor protection for the owners as an LLC, that they can only lose the value of the asset. The beauty of this is that the way you lock in this transaction is that it can only be revoked with the signature of both parties. So therefore, effectively, neither party can change the disposition of the assets without the consent of the other. And you've got a recorded transaction. So that's basic on revocable trust. I'm going to concentrate first on irrevocable trusts that accomplish all three goals that I mentioned, which is creditor protection, income tax planning, and estate tax planning. Irrevocable trusts is our first a misnomer. You can revise an irrevocable trust. The only things you cannot change in an irrevocable trust is who the beneficiaries are, nor can you postpone the distributions to them. So the issue is that we have done, and most trusts and trust tax law have a concept called of merger, where you can merge an old trust into the new trust as long as the beneficiaries are the same and they have not changed the disposition to the beneficiaries. If you have clients with really old trusts that don't have up-to-date language, this is a good way, using a merger provision, to update their trust for new law, new provisions, etc. An irrevocable trust is a separate taxpayer. It has to have a TIN. It pays taxes. At $600 a year, it will have to file a gross income. It has to file a tax return. The big disadvantage of an irrevocable trust is that it reaches the maximum ordinary tax rate of 37% at about $13,000 a year. So it is not a good vehicle for ordinary income. However, it does receive the same treatment as individuals as capital gains. So it does maintain the capital gains tax rate. Therefore, that's the type of assets you would look towards investing in this type of trust. And we'll talk further about that later. The other main issue, which you can encompass with both types of trusts, both types of irrevocable trust, grantor and non-grantor, is creditor protection. And the idea that we will talk about later of there are various types of trusts. There are several states that have trusts that allow you to create creditor protected trusts for the benefit of your clients. And we'll talk about that in a few minutes. Today, one of the most common everyone has heard of is the bypass trust. Most people today do not use bypass trust. A bypass trust, for basic idea, is the idea of utilizing the unified credit on the first to die between husband and wife. Well, portability has of the unified credit has basically eliminated the need for it, except there are several cases where it truly is an advantage. One, if you've got marriages with children from various marriages, the idea of if you want to protect assets for your children from your first marriage, but allow your spouse access to those funds under some basis, a bypass trust is good. Another one that is somewhat missed is that if you form a bypass trust, and the bypass trust also has provisions that if, God forbid, a spouse becomes disabled and would otherwise qualify for government assistance, the trust can become a special needs trust. And we'll talk more about special needs trusts later, but they're basically a trust that can be set up for someone, and it is not counted for purposes of qualification for Medicare, Medicaid, SSI. And the trust proceeds can be then used to supplement the care beyond what government will allow. Also, possibly you want to have that if the spouse is still active or has some kind of potential for liability, using a bypass trust is a way to at least creditor protect the assets for the next generation. And finally, looking at the concept of if there is going to be a significant time period between the first death and the second death, June and December marriages or health issues that have caused the premature death, assets that are going to significantly appreciate should be put potentially in a bypass trust to avoid the appreciation being part of the spouse and giving Uncle Sam a whack at those assets. Why would you create an irrevocable trust? It allows for income and estate tax planning for the grantors and potentially the descendants. With creditor protected trusts or trusts set up for next gen, they become a pre-nuptial planning vehicle because these assets, if they're held in a separate irrevocable trust, are not subject to claim as being marital assets. And they provide the ability, as an example, one thing a lot of my clients use these for is if they've set up a trust, if a child is getting married, rather than just gifting the money to them to buy a down payment, to pay for a down payment on a house, and the spouse making a gift of half of that to the future former spouses, I will refer to her as, or him as, the idea of saying, I'm going to give you the money, but I'm going to loan it to you and your wife. And therefore, if the marriage fails, the trust gets paid back with interest. So you've protected the asset for the next generation. It allows for credit since the family since the beneficiary doesn't own it, it's creditor protected. Means you don't have to worry about getting sued. You don't have to worry about the ideas of liability protection as much for family assets. You don't have to worry about stacking up income in a successful child. As we are getting, as our ages are, as we are getting a longer life expectancy, our children, or maybe already become successful. The idea of giving children outright when they are already in a state tax situation doesn't make a lot of sense to give that to Uncle Sam. So the idea of allowing a child access to the trust, but not having them have unbridled access, means those assets will grow outside of their estate for subsequent generations. The idea of this type of trust also is it can create a family bank. The idea that when you have a trust, the beneficiaries can borrow from the family bank. If the deal is successful, they can pay themselves a very high rate of return. If the deal is not successful, they can write it off, or at least the trust would be a secured creditor and would receive payment prior to unsecured creditors. So at least you protect some of the assets. We all know that we've seen issues of substance abuse with heirs, mental health issues, limited motivation. You can provide for giving the trustee a fair amount or very restricted ability to restrict distributions to generations if there are substance abuse problems, mental health issues. They're not working. The idea here is to look at what are the things that can happen to a child or any beneficiary and try to minimize the damage to them financially and being able to pass the assets on as far as to the next generation or subsequent generations. The idea also is that I think we all have seen that the nuclear family is no longer what it was. So therefore, it is quite possible if you are setting up a trust for children that some or all of those children might not have heirs. And most clients like the idea of saying, okay, if my child doesn't spend their assets and they do not have heirs, then I'd like that to stay in the family. However, I might want to give the ability to my child to say, my child's spouse has a right to the income for her life, as an example. And upon her death, the residual assets go back to the estate. These are things to consider. The other issue that people look at is that a trustee can be a bad cop for a beneficiary. The example I will give is that if a child received a significant inheritance from their parent and their spouse went to them and said, hey, honey, I've always wanted to start a t-shirt business. Why don't we use mom and dad's money for me to start it? I think we would all agree that in that case, our child is probably significantly handicapped in saying no. However, if there's a trust in place for that child, he could say, honey, great idea, wonderful, take it to the trustee, and if he approves your business plan, I'm fine. Meanwhile, while she or he is driving over, he calls the trustee and says, no way. So you put in someone who can shelter a spouse on financial issues. These trusts, as I said, have the ability to become a special needs trust. And I'll again talk a little more about the limitations on special needs trusts later on. But people say, okay, I'm giving it in trust. Does that say something negative about my kids, or why are my kids going to think I don't trust them? And the idea here is that the trustee is subject to being hired and fired by what we call a trust committee. And while the settlors or grantors are alive, they are the trust committee, giving them the unbridled right to hire and fire a trustee as long as it complies with the independence standard. They give the same right to their children upon their death for any trust set up for them. So the idea is that you have given creditor protection, estate tax protection, you have the ability to do income tax planning, and what you've given up is direct control, but you have almost complete indirect control because you as the beneficiary can hire and fire the trustee. And as long as you are not asking the trustee to do something that would breach his fiduciary duty to the other beneficiaries, then you can go as you will. And since I brought this up, I'm going to give you the one example in my in my 30 plus years of serving as trustees of various trusts, of the one time a client tried to fire me as the trustee. And this is a trust that was set up for the benefit of the surviving spouse and the children of the deceased spouse from a prior marriage. He asked that the trust buy him a Ferrari. I said, not reasonable, I refused. He said, I'll fire you. And I said, fine, but before you fire me, you better find someone who is going to replace me as trustee on an individual basis, because I don't think you will. And if I quit, you're stuck with a bank. And if you think I am difficult to deal with as a trustee, wait until you deal with the bank, who has the innate conflict of interest as serving as trustee, that they get compensated based on the assets under management. So guess what? I stayed as trustee. He did not get his Ferrari, and when he passed, his children the wife's children got what they were entitled. So you can give a lot of power to the trust committee, but get the advantages of creditor protection, income tax planning, estate tax planning, etc., through setting up trusts for the benefit of children. Some of this is repetitive, but let's do there. As you may know, there's an unlimited marital deduction. Currently, the annual gift exclusion is $17,000 a year. It is indexed for inflation. And it rises in $1,000 increments. The lifetime giving exclusion this year is $12,920,000. It will go up for inflation in 24 and in 25. And in 26, it will be 50% of the number. We are approximating it's going to be probably around between 6.5 and $7 million in 2020 in 1/1/26, when the exemption is scheduled to drop. Amounts above that are taxed at 40%. One of the a lot of issues surround how to help my children while I'm alive that we come into. And one of the ways that we find works really well is the idea of family loans. And the idea of that you may have a child that has a big cash need because they've just got divorced, they need to restart their life, or you want to help them with their business, but you don't want to own part of their business. But you do not want to distort your overall estate plan. So the idea here is that you loan your child the money with a note that is usually at the applicable federal rate, which is the lowest interest rate that charges. It provides that the note can have negative amortization, so you do not necessarily have to pay it. But what you provide in your will or estate planning documents is that in order to preserve family harmony, upon my death, I'm going to forgive this loan and possibly all the interest. However, I am going to give my other children a first out from my estate equal to the value of that loan. So effectively using this loan provision allows senior generation to make an advance to the junior generation that is caught up on the back end when it is effectively an advance on their inheritance. So this is and it avoids using any type of your gifting, because it is a loan. You can give assets to the trust through loans, through sales of an asset to a trust, and we'll talk about those in a few minutes, or potentially using a family LLC as a funding vehicle. Transfers of LLCs gives limited creditor protection, allows for an easy transfer of assets to the next generation, because you can just gift the LLC interest and it's all internal recording. Nothing has to be disclosed other than when you file the annual tax return, what the new ownership allocations are. It allows, you can make gifts using valuation discounts. The idea of lack of control, lack of marketability discounts to save in taxes. Transferring the assets to the family LLC also gives you the ability to reduce the estate taxes on the senior generation if you're able to get the senior generation below 50% and a control prior to death. Let me give you a real example of how I've used this recently. I had a client down in Georgia that had owned the real estate and had two body shops. They were in their 60s. They were ready to sell their business, but they had a little bit of a concern because both of their children, both their daughters and their son-in-law, worked in the business. They knew they couldn't run the business. They also suspected that no independent body shop coming in was going to pay them the kind of salary that the income that they needed. So this left them with a little bit of a concern. So what we did was, the real estate was already held in, each of the real estate parcels was held in one LLC. We then created a separate LLC, transferred off the LLC interest to create a holding company. Then we created an irrevocable trust and put 30% of the value of the LLC into the irrevocable trust. The income that will produce will be the replacement income, salary replacement income that mom and dad want to give. And their share of the income will be controlled by mom and dad because they are the operating managers. They are still the majority owners, and they can set the amount of distributions as well as how much they may take off for themselves in the form of a management fee in advance. But they've gotten the assets out of their estate at a discount. And the reason they did the trust is you don't necessarily want junior generation involved in decision-making revolving the sale of family assets. So by transferring the LLC interest to the trust that they are the trust committee on, when they decide to sell the real estate, they effectively completely control the transaction. They have not given any of the control to their children, and they've controlled when their children will get the assets. But through the use of the family partnership, we were able to save roughly $300,000 on $1 million gift. We saved $300,000 of gift tax utilization of their exclusion by doing this gifting. Obviously, larger deals will work even better. I think most everyone in this room on this call understands the concepts of using an irrevocable trust for life insurance, to hold life insurance. It offers the ability to have an asset that will be outside the grant, if it complies with certain rules, will allow the proceeds to flow into and for the use of the decedent's family without the imposition of estate taxes. Typically, an irrevocable life insurance trust will not have any tax returns because the only activity during life will be the payment of the premiums, since it's not generating income. It doesn't meet the $600 threshold requirement to file a tax return, so no tax return is required. A big vehicle that one of the main reasons I have a lot of clients who use insurance trust is for second to die life insurance. And there are a couple of areas where this is key. First is if you have a disabled child, the idea of while the parents are alive, they are going to do everything to take care of that child. Their biggest concern is going to be what is the funding to take care of my child when we both pass. The idea of being able to quantify that using various analysis that financial planners have, and basically buying a second to die life insurance policy for a special needs trust. Again, I'll talk a little more about special needs trust in a few minutes, but the concept of the special needs trust means that child's taken care of. You have now also provided that the disabled child is not part of the mix with regard to the family assets potentially, which if there are family businesses and other things could get messy. So this is a way to create separation. The other major area, and true story, I was involved with, a client died who lived in New York, died in 2007 with real estate valued at approximately $35 million. Uncle Sam expects to get paid 40% of that within 15 months. By the time the buildings were actually sold, they only generated $26 million because of what the market collapsed, because of the financial crisis. If you are holding significant real estate and you are if you are single, you need life insurance. If you're married, you need second to die life insurance to cover the estate taxes. If you are in a down market or heading into a down market, so you do not have to have a fire sale on real estate. Same thing is probably also true if you are close, if your significant amount of your net worth is in your closely held company. Ideas of funding, and I think, again, most people understand, I'm not going to spend any on the idea that you have to do crummy notices, that you got to inform the beneficiary they have a right to take the money out if the trustee to have a completed gift. The 3-year rule, and the other issue that people miss sometimes is that under the original Internal Revenue Code, any gift within 3 years of death was automatically sucked back into the decedent's estate for estate tax purposes as being in contemplation of death. The only area where that still applies is with life insurance. So if you are transferring an existing life insurance policy into a trust, you need to make sure that if there's any question about health, that there's a provision that says it goes to the spouse if it doesn't qualify, if it is not treated as owned by the trust, because you have not met the 3-year requirement. So those are the things to concentrate on. Other areas to consider for planning: C stock. Corporations, privately held companies who hold in C stock, transferring C stock to an irrevocable trust is a great way to build up intergenerational wealth, because the only things that come to it are dividends, which are tax and favorable capital gains rates, and sales proceeds. Those of you who were at the conference know I have a fondness for C corporations as far as overall for planning and growth purposes, and this is another reason why. This is especially true with corporations if you were lucky enough to start off and you qualify for 1202 stock treatment, which basically allows the first $10 million of taxable gain of certain privately held companies to be excluded. That's a heck of a benefit to pass on. So looking at that is corporate stock. You do not want to put an active S corporation or LLC in an irrevocable trust generally because of the high tax on ordinary income, unless you are going to distribute out the income. And that let's go back for a second. The one thing I didn't talk about when I said the maximum tax rate is at around $14,000 at 37%. However, the trust gets one deduction that normal taxpayers don't, and that is to the extent it distributes income to a beneficiary, the beneficiary pays taxes on it. So in the case that we were talking about before with the management fee, paying the fees to the children, it is assumed they are in a significantly lower tax bracket than the trust, so we would distribute the income out and maintain only the income to take it up to the maximum tax bracket. So the point is, I'm sorry, an example of this is if a trust makes $10,000 in a year and it distributes $5,000 to the beneficiary and maintains $5,000, then the trust pays tax on $5,000 and the individual pays tax on $5,000. If the distribution is $25,000, the trust pays, the individual pays all of the taxes on the income, but the principal comes to him tax-free as a return of capital. Another area where my clients use irrevocable trusts as a beneficiary is for their retirement plans, where they have children that they're concerned that they would take out all of the money from the retirement plan without regard to the 10-year allowable deferral, leaving the IRA or retirement plan to a trust, which is a qualified beneficiary, can maximize the tax benefits for the beneficiaries, even if they're not willing to do it. The other issue is to look at highly appreciated real estate again. So those are assets that can be transferred to an irrevocable trust. I've thrown out the discussion of special needs trust for several times now. Almost every state allows for because Medicare is a state-run program, even though it's funded by the federal government. Each state allows that if a trust is set up with certain requirements, that the assets of that trust will not have to be spent down and will not be used for purposes of qualification for any government assistance, which means that this is a great vehicle to protect. There are strict requirements to qualify. As I just said, the issue is, this is where, as I said, for the bypass trust, if you have an older couple and life expectancy or health issues are at play, electing to create a bypass trust for the survivor that could become a special needs trust may be a good planning vehicle. There is also what is known as a self-settled disability trust. This is used generally in situations with something like someone who's diagnosed with ALS, or someone who is going to be suffering from a major long-term disability. And so the government will allow you to set up this type of trust to make sure you get all of the government assistance you are entitled to during life. However, this trust must be approved generally by the state government, and they have a right to claw back at any remaining assets for a portion of your care. So it is always better, if you're going to have a special needs trust, that it's set up for someone else, by someone else, rather than setting it up for yourself, because there are limitations and clawbacks. Charitable remainder trusts are a great planning vehicle. These are irrevocable trusts that can be used for tax planning purposes. The idea that with a charitable remainder trust, the grantor contributes an asset to the trust. The asset then is generally highly appreciated and then sold. And since it's a charitable trust, it pays no income taxes. And at that point in time, the grantor has reserved an income interest for himself, his spouse, jointly, or for some other person for the remainder of their lives, which can either be based on a fixed amount or a percentage of the assets. It can be for a fixed term or for an individual's life. It does provide some creditor protection. Charitable lead trusts are in effect the opposite. And charitable lead trust says, I'm going to give the charity the current income from a trust, and upon my death, it's going to go at the end, it's going to go back to the children. Well, that allows for a discounting of a gift to the children, because the children are not going to receive the value of that for the number of years of the term. So this way you can give a larger portion without using up as much of your gifting exclusion. Clients who are in the M&A world will use charitable remainder trust potentially in two ways. One, they may transfer a portion of the equity in their private company to the charitable remainder trust prior to sale, and then reserve an income interest to them. Alternatively, they may decide, depending on the situation, they may decide instead to just take some of the sales proceeds and fund a charitable remainder trust to create an annuity, to create a tax deduction against the sale of the business. Grantor retained trusts. This is sort of, again, is the idea of splitting the interest up in property held in the trust between an income interest and a remainder interest. In a annuity trust, with regard to them, Generally, it's as the charitable remainder trust is a charity, this is to the family. There's gift tax on the remainder interest. Because it's a grantor retained interest trust, if the grantor dies while the trust is still paying out the income, it is part of his estate. Only the remainder is excluded. The grantor has to pay the income taxes on the assets of the trust. When would you use this? If you had highly appreciated assets generating significant income and you want to reduce the value of the estate. The other area where we have used a lot of grantor trusts are self-settled. It's now, I think, 15 or 16 states have set up what they call self-settled creditor protection trusts. These trusts provide that if they are properly set up, that those assets will not be subject to the claims of creditors of another jurisdiction, including any of the other states in the United States. So on a base level, you get sued, they get a judgment against you. If your assets are in we'll pick an Alaska trust, they would have to go to Alaska and domesticate the judgment. Under Alaskan law, they will not domesticate the judgment against assets of a creditor protected trust. The idea, people use these in several different ways. One, developers, real estate owners that have to sign a lot of personal guarantees, etc., liabilities issues. Also, lawyers, doctors who face major malpractice issues. The idea of taking some of your assets and putting them into a trust that is creditor protected, that can't be taken from you, may be of high value to some of your clients. Another area where a lot of clients have used these types of trusts is in addition to or as a replacement for a prenuptial agreement. I've done a number of prenuptial agreements over my life, and I have found that probably in a third of the cases, they don't get signed because either one side, either the marriage ends up, the fighting ends up so bad they decide not to get married, or the one who really wants the prenup finally says, this ain't worth it, I'm not signing. I'm not gonna ruin the marriage. By putting assets into a trust, into this creditor protected trust prior to the marriage, they are now no longer a marital asset. Therefore, they can be used during the marriage, could provide the ability for a spouse, if you're married, to get it on your death, not. But the idea here is that you have creditor protected the assets going forward. The problem with these trusts are, if you're retaining, you've retained ownership, you've retained control, you are paying taxes on it, and they are part of your estate. For income tax purposes, these trusts generally do not file a separate trust return. They file a disclosure of the assets because of the income, and those income items are reported on the grantor's individual income tax return. And then it has some of the same benefits as irrevocable trusts. This is about me. And if you want me to help you with complimentary calls, I'm more than willing to do complimentary consultations with you or your clients. Please use my calendar, or you can use the QRC code that's up. to book those appointments, and I turn it loose for questions, comments, criticism. Thank you for your attention.
Thank you, Stuart. I will kind of wait a few minutes to see if anyone has any questions, but several people asked me if we would be sending out the recording to this. So I just reached out to those folks directly. But for those of you who are still on, I will be sending out the recording to this presentation, as well as the white paper that we mentioned at the beginning. And it doesn't look